Hey, it's Dak Hartsock, market strategist, process portfolios at ACI Wealth Advisors. Going to review our 2016 performance in each of the portfolios today. The presentation is front loaded, so you'll be able to get the performance summary pretty quickly. Also going to grade ourselves on how we did in terms of what we expected for 2016. Have a quick survey of how the different asset classes got or did last year, and then talk a little bit about how each portfolio did for those of you that would care to stick around for that. So let's go ahead and move on. For those of you that would like to learn a little bit more about me, you can just visit dakhartsock.com/about, or of course visit the firm site at aciwealth.com/about. Very quick summary. Four of the six portfolios outperformed their benchmarks. It's a pretty volatile year in 2016. Talk a little bit more about that later. One of the portfolios outperformed the market. That's always nice to see. It's not really the goal, but when it does occur, it's rewarding for us as well as our clients. Had a very strong overall year with very good risk-adjusted returns. For those of you who don't know what that means, essentially, you take a certain amount of risk when you buy the market. If you can do or create a reasonable return with substantially less risk than what you would get for buying the market, that's when you get a risk-adjusted return that's superior to what's available in the market. And that's what most of our portfolios did in 2016. Our portfolios also mostly led the market coming into the election rally, so I'm probably one of the only managers that was a little disappointed to see the S&P rally after Trump got elected. Quick update on the recession probability indicator. The current reading is 12. For those of you that don't know, that means we're still apparently in a phase of current economic growth in the United States. So that says there's no near-term risk of recession. Historically, it's good to be invested when we are not in recession. It's bad to be fully invested when you are in recession. So this is an indicator that's very important to the way we manage funds for clients. Let's go ahead and move on. Scorecard. How did we do? Oh, we've got a little setting issue here. Let me bring all these up. These are all the expectations that we had at the beginning of the year and within the first quarter of 2016. So what we saw at that point is there was a rising risk of recession, hadn't seen a signal, so we were maintaining the full investment stance, and as it turned out there's no recession, so you're right there. We did predict the Fed was going to begin targeting rising rates and that would allow some volatility to return to the markets, so got that right. I did anticipate that volatility levels would rise more than they did. However, we had a lot of frequent spikes of volatility, which we hadn't seen prior to that. So kind of partial credit there. I'd say half right, half wrong. The market moves to upside and downside will be faster and larger. Again, half credit there. The moves were faster, but they weren't larger. We saw some substantial down moves and up moves in 2015. Didn't quite see that this year. Talked about the oil markets. Last year, the expectation was that oil would fall again before the second half, that could create renewed concerns about the credit markets in gas and oil. And the viewpoint that we had at that time was that it was very unlikely to cause a financial crisis or a recession. So got that right on both counts. We did project that 2016 gains would primarily be in the second half of the year, and we certainly expected earnings to strengthen after the second quarter, and half credit there because the market did okay in the first half of the year, first 3 quarters of the year. We did have the strongest rally of the year coming into the fourth quarter, so not quite exactly what was expected, but close. So, half right, half wrong there. The expectation last year was also that we would see consumer tailwinds from lower oil prices begin to take hold in the second quarter of 2016, and the consumer was indeed stronger in the second half of the year, and part of that I attribute to the moderation in oil prices and the cost of gasoline. Did think the economy was likely to strengthen second and possibly third quarters, supporting earnings and asset prices, and that's exactly what happened. And then the expectation for where a lot of the 2016 gains would come from, at least as far as our portfolios go, we're going to be from income and income generating activities. And again, kind of half credit there. The portfolios, and especially market income and market momentum and the equity builder we use, were helping most portfolios beat the S&P or lead the S&P coming into the election rally, and then they kind of fell behind because what happened with the S&P, which is not typical. Quick survey of asset class performance. Not going to spend too much time on this, but as we can see is some of the areas I talked about earlier in the year, specifically gold and bonds. I said when you see a massive bond rally or a massive gold rally, sometimes, typically that says there's something not quite right with the market. When you see a double-digit gain in bonds, something's not right. And as we see over the course of the year, especially later on in the year, bonds in particular gave up most of their gains, as did gold. Other asset classes did okay. The small caps had a very good year. Commodities had a very good year. That's from stabilization from oil. The S&P had a very good year, well above what it historically averages, and the Dow Jones had just a blockbuster year. I was surprised to see this number. So the world, as expected, isn't doing all that well. Those of you that follow these things know that I do not expect most of emerging markets or developed markets in Europe to outpace the United States with any consistency at all moving forward, at least not for several years. Let's move on. Live portfolio performance. Let me kind of set the table here. You see a line up top where it says benchmarks, and these are the different indexes and things that I kind of just use as a reference point for some of the portfolios. SPY, that's just the S&P 500. VBINX, that's a 60/40 stock portfolio. BXM is the buy right index. MCRO is a hedge fund tracking index. INDU, of course, is the Dow Jones, and AGG is the aggregate bond market in the United States. So let's have a look. Core equity continues to struggle, especially versus the benchmark. This is atypical. Core equity normally outperforms, or at least it has historically. And as I've said before, I think a lot of this was election rhetoric surrounding biotech, pharmaceuticals, and healthcare. And I think that's going to go away this year. So we'll see. If not, I'll begin making adjustments. Market income had another great year, outperformed the benchmark. It was outperforming the market coming into mid-November. So pretty good year with that. Another good year. It's kind of the star of our portfolios. Full cycle portfolio beat the benchmark, which was great. Beat the model too. So it's always nice to see that. This is a very good portfolio for stability and low risk. So it's doing exactly what it's designed to do. Durable opportunities, pretty good year. If we were to actually look at the cash that was invested in the portfolio versus the cash that was idle, we would have outperformed the benchmark. But you can't find all the places you want to put money to work when you want to put it to work sometimes, and that's what happened last year. Market momentum, very good risk-adjusted returns. This portfolio spends a lot of time in cash. We had some volatility, which I'll get into later in this portfolio in the fourth quarter. But despite that, we had a very good year overall. Fixed income this is the last time I'll be reporting on this model. Can't seem to get fixed income right here at ACI, so we're moving to a proven multi-manager format going forward for fixed income. We've got some very good managers that I'll introduce later in the year where this is their space and where they specialize. So we're going to bring them in and try to do a little bit better in the fixed income space. Here is 2015 and 2016 for our live portfolios. You can freeze the video if you want to kind of sit there and look at that. And of course, if there's any questions or anything else, you may email, or clients have my office number. Those of you that have been with me for a while, remember I made a lot of adjustments to durable opportunities in the second half of 2015, and we had a very strong second half and a pretty good year in 2016, especially on an invested cash basis. Okay, for those of you that don't really want to stick around for the color, we're done with the pure performance reporting. I'm going to do my 2017 outlook in a separate video, so this video isn't quite so long. So if you're hanging around for that, you really don't need to. If you'd like to understand a little bit more about the portfolios, I'd love to have you stick around, and maybe you'll have some more questions that we can talk about in the future. So here we have core equity, which is the blue line. Historically, this is a portfolio that either meets or beats the market, and does so typically at significantly less risk, somewhere between 15 and 20% less risk. Haven't seen that this year. Didn't really see that last year. It beat the market last year, but the risk differential wasn't as high as I like to see. I think 2017 is going to see that shift and it will return to its historical habits, but I'm ready to make some adjustments probably around the second quarter if we don't see core equity beginning to do what it's built to do again. So, because it has an established history of outperformance and superior risk-adjusted returns, I don't want to be hasty about this, as everyone knows if they've been following. Market income, another great year, doing exactly what it's built to do, which is deliver reasonable returns for reasonable risk while taking a little bit less risk in the market. That means about 30% less risk if you were more risk if you wanted to buy the S&P. And just so everybody knows what these lines are, the blue line is market income. The purple line is the S&P 500. The gold line is a stock bond portfolio. And of course the blue line is the market income, and these are live results. So great year, beat the index, beating the market, except for the last 25 days in December. It's not designed to beat the market, but I like to see it when it does, which it did last year. So moving on, full cycle portfolio, again, not seeing a heck of a lot of movement on a percentage basis, up or down, a little more up than down, and that's great. That's what it's built to do. This portfolio is basically designed as sort of a hedge fund alternative for people that really don't want to lose money whatsoever if it's avoidable, or at least minimize losses. It's designed to do well in essentially every phase of the economic cycle, and that's what we've seen historically, and certainly this year it's just kind of plugging away and doing what it's built to do. Nice to beat both the model and the different benchmarks this year, and hopefully we'll see continued performance like this, maybe even a bit higher next year. Durable opportunities, for those of you that aren't sure, this is our only individual stock portfolio, looking for companies that are going to be around for a long time and that have capital structures and management that are going to be able to take advantage of their markets and do so in a way that pretty much makes it very difficult for others to compete with them. And some of these companies are kind of core companies in the global economy. Sometimes that works out really great. We've had some things that worked out really well. Sometimes not so great. In 2015, we had a big piece of Exxon, and that didn't work out so great, but we still got some Exxon. It's worth owning as long as you don't have too much of it. At any rate, portfolio is doing a great job this year in 2016. If we were just looking at the dollars that were invested versus the indexes or the benchmarks, we would have outperformed. So either way, great numbers for the year. Market momentum, this is very similar to the market income portfolio in terms of how it's managed, because we're really looking for some decent risk-adjusted returns. And what I said earlier in the year in 2016 is I thought we'd see some volatility in this portfolio coming into the summer, and that is of course what we saw. Here you see the blue line, and then somewhere around late September or early October I said the same thing, that I'm expecting a big jump in volatility moving into the end of the year, but that I expect that to mitigate as we move through the election and some of the events that were occurring. And again, that's kind of exactly what we saw. Here's the volatility, and here we bounce right back up. So pretty good year for market momentum. Barring recession, I would expect some very good things out of this coming into 2017. So that's it. Thank you very much for your time. As always, I appreciate the company on these things. If you have any questions, there's my email right down there at the bottom. Clients, of course, have the office number. Or you may visit either one of the sites and go to the contact page. Happy to answer any questions from whoever is out there, whether you're a client, whether you're a current subscriber, or whether you just got curious and this was forwarded to you by a friend. I'm here to answer questions and help whomever I can. So other than that, Happy New Year to everyone. I'll have a 2017 market outlook out very soon. And until next time, thanks very much. And we'll do the disclosures and the theme music. Take care.